Every financial crisis begins the same way. Not with panic, not with collapse, but with the quiet disappearance of something most people never think about: liquidity. One day the markets are functioning smoothly. Banks are lending, businesses are borrowing, investors are trading, and then, without warning, the machine seizes. Nobody can sell. Nobody can borrow. Assets that were worth millions yesterday are worth nothing today because there is no one on the other side of the trade. This is not theory. This is the pattern that has destroyed fortunes, toppled governments, and reshaped economies for centuries. And the most dangerous part? Most people don't even understand what liquidity is until the moment it vanishes. Liquidity is the lifeblood of modern finance. It is the ability to convert an asset into cash quickly without losing value. When liquidity is abundant, markets feel safe. Prices rise steadily, investors grow confident. But liquidity is not a constant. It is a mood, and moods change. When confidence breaks, liquidity evaporates faster than any central bank can replace it. Suddenly, the assets everyone thought were solid, real estate, bonds, even gold, become impossible to sell at any reasonable price. The market doesn't crash because values disappear. It crashes because liquidity disappears. And without liquidity, value has no meaning. History is littered with the corpses of investors who learned this lesson too late. They held assets they believed were safe, diversified portfolios, blue-chip stocks, government bonds, but when the crisis hit, none of it mattered. The market had no buyers. Liquidity vanished. They were left holding paper that nobody wanted. This is the liquidity illusion, the belief that because you can sell today, you will be able to sell tomorrow. It is one of the most expensive mistakes in finance, when it repeats in every generation. Let's start in 1720 with the South Sea Bubble, one of the earliest and most brutal examples of liquidity collapse in modern financial history. The South Sea Company was a British joint stock company, granted a monopoly on trade with South America. Investors, including members of parliament and even the king, poured money into the stock, convinced it would generate enormous profits. The stock price soared from around £100 per share to over 1,000 in a matter of months. Fortunes were made on paper. Ordinary people mortgaged their homes to buy shares. The mania was total. But here's what most people miss about the South Sea Bubble. It didn't collapse because the company was worthless, though it was. It collapsed because liquidity dried up. As the stock price climbed, early investors began taking profits. They sold shares and converted them into cash or land. This was rational behavior, but it created a problem. The higher the stock price went, the more cash was needed to sustain it. Eventually, there were not enough buyers to absorb the selling. The market turned. And when it did, liquidity vanished instantly. Investors who had been wealthy one week found themselves ruined the next. They tried to sell their shares but could not find buyers at any price. The stock that had traded at £1,000 per share was suddenly worth 50, then 20, then nothing. Thousands of families were destroyed. The British government launched investigations, and several company directors were imprisoned, but the damage was done. The South Sea Bubble taught a lesson that would be forgotten and relearned countless times. Liquidity is not guaranteed. It exists only as long as confidence exists, and confidence can vanish in an afternoon. Move forward to 1907, and we see the same pattern play out in the United States. The panic of 1907 began with the collapse of a speculative attempt to corner the copper market. A group of investors, led by a financier named Augustus Hines, tried to monopolize shares of United Copper Company. The scheme failed spectacularly. Hines's brokerage went bankrupt. Depositors panicked and began withdrawing money from banks associated with Hines. Within days, the panic spread to other banks. By mid-October, some of New York's largest financial institutions were on the verge of collapse. What made the panic so devastating was not the initial losses. It was the sudden evaporation of liquidity. Banks that had been solvent one day were insolvent the next because they could not convert their assets into cash quickly enough to meet withdrawals. They held mortgages, bonds, and commercial paper, all theoretically valuable. But in a panic, theoretical value means nothing. There were no buyers. The assets were illiquid. The banks failed. The crisis was only resolved when J.P. Morgan personally intervened, organizing a consortium of wealthy bankers to inject liquidity into the system. Morgan forced banks to lend to each other, convinced trust companies to honor withdrawals, and even propped up the New York Stock Exchange to prevent a total collapse. It worked, but barely. The panic of 1907 exposed a fundamental weakness in the American financial system. It had no central bank, no lender of last resort to provide liquidity in a crisis. That weakness would lead directly to the creation of the Federal Reserve in 1913. But the lesson was clear. Liquidity is fragile, and when it disappears, even the strongest institutions can fall. The Great Depression offers an even more brutal case study. Between 1929 and 1933, the U.S. stock market lost nearly 90% of its value. Unemployment soared to 25%. Banks failed by the thousands. Industrial production collapsed. It was the worst economic catastrophe in modern history, and at the center of it all was a liquidity crisis that spiraled out of control. The crash began in October 1929, but the real devastation came afterward. Stock prices fell. Investors who had bought on margin, borrowing money to purchase shares, were forced to sell to cover their loans. This created a cascade. trade. Selling begat more selling. Prices fell further. More margin calls were triggered. More forced selling. Liquidity drained from the market. By 1932, stocks that had been worth hundreds of dollars were trading for pennies. But here's the key point. Many of these companies were still operating. They still had factories, employees, customers. The assets were real. But the market had no liquidity. And without liquidity, assets could not be sold except at fire sale prices. The banking system suffered the same fate. As depositors panicked and withdrew their savings, banks were forced to sell assets to raise cash. But in a collapsing market, there were no buyers. Mortgages, bonds, commercial loans, all of it became illiquid. Banks failed not because they were insolvent in a fundamental sense, but because they could not convert their assets into cash fast enough to meet withdrawals. Over 9,000 banks failed during the Depression. Millions of Americans lost their life savings, and the economy did not recover for more than a decade. What made the Depression so catastrophic was not just the initial shock, it was the Federal Reserve's failure to inject liquidity into the system. Instead of lending aggressively to solvent but illiquid banks, the Fed tightened monetary policy, raising interest rates and allowing the money supply to contract. This was economic malpractice. Turned a liquidity crisis into a solvency crisis. Banks that could have survived with emergency lending were instead allowed to fail. The lesson was painful and clear. In a liquidity crisis, doing nothing is the worst possible response. Fast forward to 2008, and the pattern repeats with terrifying precision. The global financial crisis began with subprime mortgages in the United States. Banks had bundled these mortgages into securities and sold them to investors around the world. When housing prices began to fall and borrowers defaulted, the value of these securities collapsed. But the real crisis was not the losses, was the liquidity freeze. In September 2008, Lehman Brothers, one of the largest investment banks in the world, filed for bankruptcy. The announcement sent shockwaves through global markets. Investors panicked. Everyone tried to sell at once, but there were no buyers. Liquidity vanished from entire asset classes. Mortgage-backed securities, corporate bonds, even short-term commercial paper became impossible to trade. The market seized. What followed was a terrifying scramble. Banks stopped lending to each other because they did not know which institutions were solvent. The interbank lending market, the circulatory system of global finance, froze. Central banks around the world were forced to intervene on a scale never before seen. The Federal Reserve, the European Central Bank, the Bank of England, all of them injected trillions of dollars, euros, and pounds into the system to restore liquidity. They bought assets no one else would touch. They lent to institutions that could not borrow anywhere else. It worked, but it was a close call. The global financial system came within hours of total collapse. The 2008 crisis revealed something most people still do not understand. Modern finance is built on the assumption of liquidity. Banks operate with minimal reserves because they assume they can always borrow or sell assets if they need cash. Investors hold complex securities because they assume they can always find a buyer. Governments issue enormous amounts of debt because they assume markets will always absorb it. But all of these assumptions rest on confidence. And when confidence breaks, liquidity disappears. The system that looked so robust one day becomes a house of cards the next. Since 2008, central banks have tried to prevent another liquidity crisis by flooding the system with money. Quantitative easing, zero interest rates, emergency lending facilities, all of it designed to ensure that liquidity never disappears again. But this creates a new problem: moral hazard. Investors have learned that central banks will always step in to provide liquidity in a crisis. This encourages reckless behavior. Why worry about liquidity risk if the Fed will always bail you out? Why hold cash if you can lever up and chase higher returns? The system has become addicted to central bank intervention, and that addiction is building the next crisis. Consider what happened in March 2020 when the COVID pandemic hit. Markets collapsed because liquidity evaporated. Investors sold everything, stocks, bonds, even gold, to raise cash. The selling was so intense that even U.S. Treasury bonds, supposedly the safest and most liquid asset in the world, became difficult to trade. The Federal Reserve was forced to intervene again, buying trillions of dollars in assets to restore liquidity. It worked, but it also proved that the system is more fragile than ever. Safe. Here's the deeper problem. Liquidity is not just a technical issue, it is a psychological one. Markets are liquid when people believe they are liquid. The moment that belief cracks, liquidity disappears no matter how much money central banks print. It's because liquidity is not just about the availability of cash. It is about the willingness of someone to take the other side of your trade. And in a panic, no one is willing. Everyone wants to sell. No one wants to buy. Price becomes irrelevant because there is no price at which a trade can occur. This is why liquidity crises are so destructive. They do not destroy value gradually. They destroy it instantly. An asset that was worth $100 yesterday might be worth $50 today. Not because anything fundamental changed, but because liquidity disappeared. And in a true liquidity crisis, even $50 is optimistic. The asset might be worth nothing because there is no market at all. So what does this mean for you? It means that the assets you hold, the stocks, the bonds, the real estate, are only as valuable as the liquidity that supports them. If you cannot sell them when you need to, they are worthless. This is not pessimism. It is realism. Every financial crisis in history has been a liquidity crisis first and a solvency crisis second. The investors who survive are not the ones with the best assets, or the ones with the most liquidity. The liquidity illusion is the belief that markets will always be there when you need them, that you can always sell, there will always be a bid. History proves otherwise. Liquidity is a gift from the crowd, and the crowd is fickle. When confidence breaks, the gift is withdrawn. Those who depended on it are left holding nothing. The question you should be asking is not what your assets are worth today. T is what they will be worth when liquidity disappears, because it will disappear. It always does.
Out.
The only question is whether you will be ready.